In this module of Veripax University, we're going to be looking at two major investment styles. The first is market-based investing, which is by far the most common that we see in the financial world. And the second one is goal-based investing, which happens to be the one that Veripax Wealth Management follows. This video is for informational and educational purposes only, and there's nothing in this presentation that should be taken as financial advice. Sometimes I feel we invest simply because it's what we're supposed to do, and we never really stop and ask, what's the purpose of our investing? Because when we invest, we're putting our wealth at risk. And what we mean by risk is the probability of loss. So we probably should be clear on the purpose of putting our wealth at risk. So why do we do that? Well, if we're honest with ourselves, in a lot of cases we do it because we want to make as much money as possible, and we think that by putting our money into the stock market or other investment vehicles that we'll be able to make a lot of money. Another one is that we may be falling behind on our retirement or just general savings, and we want to catch up, and we feel like the best place to do that is the stock market. This is where we really have to be honest with ourselves. If we hear our neighbor is making a bunch of money on crypto marijuana stocks, or our brother-in-law is bragging at a party on how much he made on Google or Apple this last month, we feel like we should be able to do that too. And so in some aspects, there's a bit of a competition aspect to it. And that goes somewhat hand in hand with the fear of missing out. It just sometimes feels like everyone else is making money, certainly more money than we are, and so we want to be able to participate. And then finally, and this is where we really need to spend time thinking about the purpose of investing, is we invest in order to increase the chances of meeting financial goals. That by putting our wealth at risk, we're willing to take that educated risk in the hopes that we'll have a better chance of meeting our financial goals. Almost everybody would agree that meeting financial goals is the purpose of investing, but oftentimes our actions indicate that we're actually investing for a very different purpose. Because most people view the stock market as the best place to put their money at risk in order to get a big return, I wanted to take a look at what I think is a myth of market returns. In this table, I'm showing a whole sequence of 20-year chunks of time and what the average return in the US stock market was. And you can see that it's not always all that great. Let's zoom in here on this 1960 to 1980 time period. And you can see that it was a little bit choppy. And when you average the return over that 20 years, it ended up being only 4.23%, much lower than what most people would expect from long-term market returns. This time period, 1982 to 2002, actually started in about 1981, was an outstanding time for stocks. So this was the advent of 401ks, it was a dot-com bubble, beginning of internet trading, and just incredible access to the markets for people that had never had access to the markets before. And it resulted in an outstanding return for stocks. And that's what tends to set the tone for what people think of as normal market behavior. But then let's take a look at another 20-year chunk, 1991 to 2011. This was, again, the back half of that dot-com bubble, but then followed by a dot-com crash, a real estate bubble, a great recession. And by the time you average it all out, it's 5.6%. A little more recently, so ending in February 2019, now we do have half of this period that was one of the longest recoveries in bull markets in history, but when we average it over the entire 20 years, we're only at about 4%. And I would argue we're at a pretty high valuation of the market today. So a lot of people view the long-term returns of the market as almost a high-interest savings account. As long as they have a long time to go, that there's really very little risk and they're going to get these big returns. But then where is this 10% average market return? Well, there's a couple of areas. I mean, if you just look at the last 10 years, we've had over a 15% average return. So that's been great recently. And there is a thing called recency bias that makes us think that whatever happened in the recent past is what's normal. But really, the market, by carefully choosing beginning points and ending points, we can get market performance to tell us almost anything that we want it to. And unfortunately, this term, long term, is completely undefined, and it certainly doesn't conform to anyone's specific financial requirements. So as I mentioned before, there's certain sections of market history that tend to set the tone for the rest of it. And because everybody gets excited when the market goes up, it's the out of the norm good spots that tend to set the tone for the rest of the market. There's also an underlying assumption whenever we talk about average rates of return that those returns will repeat themselves, even though the disclaimer on the bottom of every page of a performance chart says that we can't depend on history to repeat itself. So the key thing here is that market returns depend heavily on starting and ending points. Whenever you see a long-term return of the market that's in the 8, 9, 10% range, you can pretty much guarantee that the starting point always begins at a low point. And I would argue that we're not at a low point today. Now let's take a look at these two investment styles. And I call them investment styles because how we measure success tends to determine how we put portfolios together and therefore determines our investment style. So the vast majority of investment strategies tend to measure their progress and success by taking a look at the market and comparing themselves to the market, whether that's the S&P 500, which is the US large company stocks, or maybe it's a benchmark that consists of 60% stocks and 40% bonds. In some way, our measure of success ties back to how we could have done if we had just invested in the market. And this has given rise to several different strategies, and one of the most common and fastest growing strategy is what we call index strategies. This is where we concede that really we can't beat the market over time, and therefore we should just get the lowest cost, most unmanaged investments we can find and follow the market wherever it tends to go. There's other people that still feel like they can pick stocks that will outperform the market, and so there's a lot of different stock picking strategies or trying to time when to get in and out of stocks in order to beat the market. And obviously there's thousands of mutual funds to choose from with managers that are trying to do these stock picking strategies. But ultimately, again, it all ties back to the stock market and hoping that somehow the stock market will continue to repeat itself and will line up with our financial goals, including the timing of our financial goals. Another way to measure success, and again, this is how Veripax Wealth Management would view the world, is by taking a look at our actual financial goals. By doing this, we can come up with a financial plan that says, well, we want to retire in 15 or 20 years, or we have college to pay for, or we want to take a big vacation when we hit our 50th wedding anniversary. Whatever the financial goals are, we can determine how much do we need to save each year and what kind of a return do we need to make on those savings in order to meet our financial goals. Once we've determined that rate of return, we can now use that rate of return as a benchmark that actually ties into our financial goals. This is very similar to how pension funds and endowment funds manage their portfolios. They have very specific requirements for how much they need to distribute each year. They also know 10, 15, 20 years down the road, what kind of an overall rate of return do they need to make in order to continue to meet those distributions. And so they'll design portfolios that hit those growth targets with high reliability. They're not going to depend on the random movements of the market, which we've seen even over 20-year time periods. There's nothing that determines what the market returns will be. And so what we want to do is identify our specific goals and try to meet those with high probability. And again, just to drive the point home, how we measure success tends to drive how the portfolio is built and therefore determines our investment style. I want to conclude with a side-by-side comparison that just shows the two different investment styles. So let's say we have a requirement, we want to retire in 15 years. We've done a financial plan and determined that with our savings rate and a 5% average growth rate per year, we can retire in 15 years. The vast majority of the industry will then build a portfolio that follows a market-based benchmark for some reason. So I created a hypothetical portfolio using the S&P 500 as a benchmark. I started it a little before 1999. It was a couple years before the next recession, which by probably the majority of the supposedly expert opinions, we're probably within 1 to 3 years of a recession today. So I think that's a fairly decent proxy. But in this case, this hypothetical portfolio, we beat the benchmark by 1.5% every year. And if we do the math, that turns out that after 15 years, we were still 14.6% short of our requirement to retire. The other issue here is that during this entire time that we beat our benchmark every single year, did we ever feel good about the fact that we were on track to our investment goals? And I would argue no, because our benchmark had nothing to do with our investment goals. So by contrast, let's take a look at more of a goal-based approach. So we've done our financial plan. We've determined that we need to meet or beat at least 5% average rate of return every year. Why on earth then is our benchmark not 5% per year? We can just draw a straight line that goes up 5% a year. And now we have something tangible to measure against. Now, does this mean that every time we fall below it, we need to get worried? Not necessarily. But if we stay consistently below that goal or that indicator, or we get too far below it, then maybe we do need to reevaluate our strategy, or maybe we need to reevaluate our goals. But at least now we have something tangible that can tell us when we need to do that. So if your true goal is one of those earlier things we talked about, whether it's beating your brother-in-law or you just don't like that feeling of missing out when the market does have a couple of big years, then maybe you would pick a market-based benchmark. But for true financial goals, where you're actually trying to accomplish something tangible within a specific time frame, we just feel like a goal-based benchmark and therefore a goal-based investment strategy is the best way to go for us. All right, that's enough on this topic. Thank you very much for listening.